Turkish central bank has just raised its key policy rate by another 500 basis points, bringing the one-week repo rate to 30%. That's following a total of 1,650 basis points increase since July. The raise was in line with overall market forecasts. In June, Turkiye lifted its key interest rate for the first time in more than 2 years. And after starting on its hiking path, the central bank in July stated its aim to get inflation down to 5% in the medium term. Inflation jumped to 59% in August, and Ankara now expects annual inflation to reach 65% at the end of 2023. For more on this now, let's bring in economist Murat Ferman. He's a professor at Beykent University here in Istanbul. Thank you for joining us today. Professor, this is supposedly going to have a very positive impact on inflation. Can you share with us your outlook on inflation? I'm talking about the short term, but also the longer term.
Yes, inflation is an ongoing process. First and foremost, greetings from Istanbul. Of course, we all know that inflation does not happen overnight, and nor does perish in a click of a finger, as they say. So what happens is that we need a kind of a carefully balanced, very keenly structured framework to fight against inflation. First and foremost, there must be some measures to really stop the upheaval or upward mobility in inflation. And today's Turkey Central Bank, with another solid and rational move, raised the interests, confirming to the majority of market expectations by 5 points. Therefore, this constitutes the fourth consecutive interest rate hike. And of course, this by itself is not sufficient enough to curb the so-called appetite of inflation to go higher. However, Turkey's main strategy is to go ahead based on a strong foundation. This foundation really stems from fiscal tightening, which is mostly under the authority and jurisdiction of the Turkish Central Bank, and of course macro-prudential actions, as well as so-called structural reforms, combined all of them together under a framework of strategical initiative. Turkey stands a good chance to take, first and foremost, to take inflation under control, try to tackle down some of the root causes of inflation, and then hopefully by next year take it under control.
Right, and quickly, as you say, that's a solid and rational move. But what about those growth forecasts, though? Will this have any impact on growth, even considering the government spending was high at the beginning of the year and that has been supporting GDP growth for Turkey?
Yeah, all of these restrictive policies, including interest rate hikes, does constitute a kind of a risk or a challenge of curbing the appetite for growth. As you know, restrictive strategies are not helping so-called growth strategies. No wonder in the recent years, under the leadership or captainship of American Fed, as most of the central banks are using this method, restrictive policies by raising interest rates or interest rate hikes, there is always the challenge or the rumor of inviting recession and, God forbid, stagflation in an unclosed future. So therefore, it is of extreme importance try to find a balance between so-called restrictive policies and all kind of activities helping growth. Selective credit mechanism is one of the ways to really enforce it. And as Vice President Cevdet Yılmaz clearly indicated that under the auspices of the 12th five-year development plan, Turkey would like to put together a growth formula